Hello, all my dear students. I hope you all are doing good. I hope your studies are going on great. So today's this video is not only for our students who are going to give their exams in May 26, September 26, Jan 27. I don't know how this important this judgment is going to be in your exams, but this judgment is very important practically. So this judgment should be heard by all the students as well as all the qualified chartered accountant, irrespective of whether you are practicing in income tax or not. So I'm making a small crux of this judgment. This judgment, which has come as a landmark judgment of Supreme Court just 2 days back on 15th of January 2026. It's one of the most landmark judgment that the Supreme Court has passed, and it's a very important win for the Indian Income Tax Authority against the global tax evasions. So I'll be making this judgment in a very crux manner. I may not be able to speak every aspect of this judgment, but I will try to speak most of the important aspect of this judgment. The judgment of the Supreme Court, which came 2 days back, runs in hundreds of pages. I have read the entire judgment once from my side, and I have made a crux of that to explain you all, so that if you don't have the entire time to read the entire judgment, you can listen to the crux and understand what is the recent development in the international taxation. I'll be making this judgment video only in English so that every student takes advantage of this. If you want to listen, you can make it auto mode in Hindi and you can listen it. Okay, I'll not be recording this again in Hindi. I'm not in the town, I'm somewhere out. I tried to arrange a recording system over here and I'm trying to record it over here. So what has happened just 2 days back in the Supreme Court case is something which has happened around 8 years back in 2018. There is a company by the name called as Tiger Global, which is set up in Mauritius. And there are 3 entities which are set up in Mauritius: Tiger Global 2, Tiger Global 3, Tiger Global 4. 3 entities were set up in Mauritius by whom? By Tiger LLC, which is a separate company, which is the parent company. They have set up 3 companies over here. Why they have set up 3 companies over here? To acquire shares in Flipkart India. They don't want to acquire the shares in India, Flipkart India directly, because it is similar to what has happened in Vodafone case law. But it is just one layer ahead of that. They don't want to acquire directly in Vodafone, they don't want to acquire directly in Flipkart India. So they are acquiring through multiple countries. So what has happened over here? There is one company by the name called as Tiger Management LLC, which has made 3 subsidiaries in Mauritius. After that, they acquired shares in Flipkart Singapore. And eventually, Flipkart Singapore derived its value substantially from asset located in India. Okay. Now, what they are trying to do? They are trying to, this Management LLC has nothing to do in this. They have just formed an entity over here. Now, the entire discussion is between these 4 entities. You focus on these 4 entities. One entity, which is in Mauritius, which has been split into 3 subsidiaries. These 3 subsidiaries hold shares in a Singapore company, and eventually they have sold the shares of the Singapore company to a Luxembourg company, around 17% stake, and that Luxembourg company is held by Walmart. You all know that Flipkart is ultimately owned by Walmart now. Okay, a major stake is there by Walmart only. So now try to understand these 4 entities. Tiger Global, Mauritius, holding shares in Singapore, Flipkart. And Singapore Flipkart ultimately derive its value substantially from asset located in India as per explanation 5 to section 911. I hope everybody knows that. What does section 9(1) of explanation 5 says? That the share of a foreign company derive its value substantially from asset located in India, then it is deemed to be located in India, and their income will be subject to tax in India. Which income? Capital gains income. Now, to address such issues, they have sold this entire Flipkart shares to Luxembourg company in 2018. For this purpose, Tiger Global has already approached Authority for Advance Ruling. The Authority for Advance Ruling, they have gone to Authority for Advance Ruling. They made an application to Authority for Advance Ruling for determining the tax liability with respect to this transaction. They were very intelligent. They went to Authority for Advance Ruling so that they should get a ruling in advance, and then the Income Tax Authority should not raise any question on that, because the ruling of advance ruling is binding on the authority. So this Tiger Global was very intelligent. They went to Authority for Advance Ruling. But the Authority for Advance Ruling in 2020, they rejected their application. Why? Because you might be knowing, you have learned in CA final also, there are 3 cases in which Authority for Advance Ruling has the power to reject the application. They will not listen also your case. One of the case which is in our book in the last line, in the last column, 3 cases were there, last column, where the Authority for Advance Ruling is of the opinion that the transaction is designed prima facie to avoid tax in India. So the moment the authority for advance ruling comes to know that the transaction was done with an objective of evading tax in India, they have the power to reject the application. So they rejected Tiger Global application. They came to authority for advance ruling for claiming treaty benefits between India and Mauritius. They were saying that India and Mauritius does not have capital gain tax and we are resident of Mauritius, and therefore our capital gain should be taxable in Mauritius, but ultimately Mauritius does not have capital gain tax. So we want treaty benefits of Mauritius, India, DTAA, but the AAR rejected that on the ground of what? It is a prima facie transaction to avoid tax in India. Then they knew that this transaction will be 100% subject to tax. Nothing can be done now. If this transaction is subject, because AAR has rejected, and if this transaction is subject to tax, obviously this Luxembourg company who is buying the share, they have to deduct TDS under 195. So the Luxembourg company said that we will deduct your TDS. So this Tiger Global played one more game. They went to the assessing officer. And under section 197, they said assessing officer that yes, it is taxable, agree, but under India DTAA, India Mauritius DTAA, it is taxable at nil rate because we want the treaty benefits. Now AAR has rejected the application. So they are now going to assessing officer to claim benefits. The assessing officer also said that no, we will not give you treaty benefits because this entity is formed with an objective of evading tax in India. It is not a genuine entity. It's a shell company. It's a conduit which has been made with an objective of tax evasion in India. Therefore, the assessing officer said that I will not give you a nil rate deduction certificate. I will give you a deduction certificate with a lower rate. So the officer said that I will give you a deduction certificate with a lower rate because this Luxembourg company was saying that we want either a nil rate or else we will deduct TDS, because otherwise the officer will ask us why you have not deducted the TDS. So this Luxembourg company has done properly. So this Luxembourg company told Tiger Global that we want either a nil rate certificate from the Indian Tax Authority or else we will deduct the TDS. The Indian Tax Authority did not give the nil rate certificate, and therefore the Indian Tax Authority, that is the assessing officer, gave a certificate of lower tax deduction. The officer said that yes, I will not give you nil rate certificate, I will give you lower tax deduction certificate. I don't know the exact rate which was said by the officer, but the amount which was set to be deducted by the officer was 967 point something. 967 crore you have to deduct, and they have deducted. The Luxembourg company has done whatever they had to do. The Luxembourg company is owned by Walmart Inc. ultimately. So this Luxembourg company is ultimately owned by Walmart Inc. So ultimately this Flipkart shares are purchased by Walmart only indirectly through so many entities you can see. Now what is the role? So this TDS was deducted. Now what is the role of Tiger Global? The Tiger Global has to pay the balance money from its pocket. But the Tiger Global was still under a belief that we are not liable to pay tax. They challenged this particular thing at various levels and the matter went to Delhi High Court in 2024. The Delhi High Court said that the Income Tax Authority is wrong and Tiger Global is correct. And Delhi High Court gave the judgment in favor of Tiger Global and said that there is no need to what? Pay tax for Tiger Global because there is a DTAA between India and Mauritius, and therefore Tiger Global will not be subject to tax in India. Therefore, the Delhi High Court also said that refund this TDS also to the assessee. Because you have deducted this TDS of the assessee, you have to refund that to the assessee. Now the matter went to Supreme Court and the Supreme Court gave judgment on 15th of January 2026. And what Supreme Court said? The Supreme Court said that no, the Tiger Global is absolutely wrong. We cannot give Tiger Global the DTAA benefit. Why? Because this entity was formed with an objective of taking undue treaty benefits. This entity was formed with an objective of doing an impermissible avoidance arrangement. The assessing officer applied GAR on the assessee. And we all know that if you do any transaction with an objective of evading tax of more than 3 crore rupees and your main purpose is evading tax and the entity which is formed by you lacks commercial substance, in that case, the officer has the power to impose GAR. And we all know that the GAR provisions also override the treaty benefits. GAR not only overrides the income tax provision, GAR also overrides the treaty benefits. Therefore, the Supreme Court has given multiple points in the judgment. First, the Supreme Court said the entity in Mauritius lacks commercial substance. Therefore, impermissible avoidance arrangement is absolutely perfect. GAR has to be invoked. The assessee was giving an argument that I am a resident of what? I am a resident of Mauritius. Therefore, I should get The treaty benefit of India, Mauritius, DTAA. The Supreme Court held that only holding TRC is not sufficient. Especially when your objective of making an entity in Mauritius is what? Is to evade tax in India. There was no commercial activity done by that company. There was no real economic activity done by that company. That company was only formed with an objective of transferring the assets of India by holding a share in third company and then ultimately transferring the assets of Indian company. Next, the transaction was deemed designed to exploit treaty benefits without real economic activity in Mauritius. There was nothing done in Mauritius. The Mauritius entity was only engaged in buying and selling the shares of Singapore company, which was ultimately transferring the assets in Indian company. Fourth, the Delhi High Court overruled the judgment of what? Of tribunal. But the Supreme Court ultimately overruled the judgment of Delhi High Court. Now, there are a lot of other doubts which can come to your mind. What is the ultimate conclusion of this case, sir? The ultimate conclusion of this case is, if the shares of the foreign company derive its value substantially from asset located in India, then it will be taxable in India. And even if the treaty gives you benefit, we will not give you the treaty benefit if your objective of making that entity was to only evade tax in India. We will not give you the treaty benefits. We will invoke GAR on you. See, when Vodafone case law came, at that time GAR was not there. GAR came after 2017 and this case happened in 2018. The CBDT said that we will not invoke this case. We will not take this as a binding precedent for cases which has happened before 2017. The CBDT has given a press release yesterday, whereby they have said, we will not apply this as a binding precedent on the cases which has happened before 2017. We will apply this case only on the cases which is happening after 2017, not before 2017. Now, there are many other issues which can come to your mind. I would like to address all those issues. Sir, whether this transaction is not taxable in Singapore? No. This transaction is not taxable in Singapore. Why? Because Singapore generally does not take capital gain tax. It only takes taxes on trading activities. Capital gain taxes are not applicable in Singapore. This transaction is not applicable in Singapore. It is not subject to tax in Singapore. That is the only reason they have routed this transaction to Singapore. They have not directly routed. There is another doubt which can come to people's mind. Sir, can't Tiger Global Mauritius invoke MAP proceedings under Article 25? Can they invoke mutual agreement procedures under Article 25? No, they cannot. Why? Mutual agreement procedures are generally invoked in two cases. When there is an unintended double taxation between two nations. There is no concept of double taxation over here. The issue was not with respect to double taxation. Or if there is a conflict in interpretation of treaty. There is no conflict in interpretation of treaty, nor there is a double taxation issue over here. The issue over here is whether the treaty benefits will be available or not. That was the issue. And that is not addressed by MAP. Mutual agreement procedures are not made for that purpose. It is made for reducing unintended double taxation. Then the two competent authority will come forward and will address the issue. Or the mutual agreement procedures will come for application or interpretation of treaty. If there is wrong interpretation of treaty between two nations, then the mutual agreement procedure will come and the two competent authority will sit together on a table and interpret the treaty. The treaty was very clear. Everything was very clear. MAP proceedings cannot be invoked over here. Whatever could have been done by Tiger, they have done. First, they could have gone to AAR. They went to AAR. AAR rejected the application on a prima facie tax avoidance case. They went to assessing officer under 197. 197 AO rejected the application and said that I will not give you nil rate certificate. I will give you reduced rate certificate. So reduced rate certificate is 967 crore. Tell the deductor, tell the payer to deduct this much, and the deductor deducted this much. And the balance you can pay from your pocket. The Tiger Global can pay from the pocket. Now ultimately, whose liability it is now to pay? It is Tiger Global's liability now to pay. Now let's see. The judgment has come day before yesterday only. Exact tax amount I don't know. It is not the duty of the Supreme Court to determine tax liability. The exact tax liability will be determined by the assessing officer in the next 3 months, whereby the assessing officer will determine the exact tax liability along with the interest, and if penalty can also be imposed, he will impose that also. And then he will give the credit of what? 967 crore rupees of TDS. So this is what this beautiful case is all about. I have just given you a synopsis of this case. This case is way bigger than what I have said you. This case has many other aspects. I don't have time. I've read the entire case and many things you may not be able to understand also at this point of time, especially if you are a student. I'm making this case from the perspective of student come practicing chartered accountant, but more from student friendly perspective. I hope you all like the case. If you have liked the case, please comment below, share your views. and consider this case to be very important for your exams, maybe from September 2026 onwards. Whenever ICI will put this case in the study material, I will address this case accordingly for your exam purpose also. Till then, take care all of you. Bye. Take care.